Hey all, welcome back to another video. My name's Adam Jason. I am the founder of BRRRRinvest.com. If you've seen any of our other videos, you know that my mission is to provide you guys with the resources, information, knowledge, all that you need to make BRRRR investing easier for you than ever before and help you reach those goals of financial freedom that we're all aiming for and shooting for. We just finished, and I hope you enjoyed it. If you haven't seen it, I'll include a note here so that you can watch a 5-part series on how to raise capital as BRRRR investors. So we covered everything from forming your LLCs to setting market terms, all the kind of things that you'd want to do if you are going to be reaching out to fellow investors and asking them to participate in your deals. One of the follow-up questions I got from one client of mine is, okay, I'm a little nervous about SEC regulation and thinking about what I have to do there. I don't want to say the wrong things. I don't want to not file documents I have to. I don't want to run any regulatory risk that might come from asking for money from investors. The client's smart, understands that this is something that, as folks who are potentially soliciting capital and investment from other people, that we do have to be thinking about. My background is as a BRRRR investor, but also I am a professional attorney. I've been working with clients, Fortune 500 companies, large investment banks, and now my own real estate firm, raising money in public and private markets for the last 10 years. So I think I'm uniquely qualified, being both a BRRRR investor and an attorney in this space, to help guide you through this and start thinking about it. So our question for today, and the thing I really want to focus on, is at what point, if you're asking people for money, asking people to participate alongside with you in deals, do you have to start thinking about SEC regulation, compliance, and what all that might mean? Here's the fundamental issue. The SEC regulates what they consider to be public offerings. If what you're doing is not a public offering, there's an exemption for that, and the SEC is not really interested in what you're doing. Your only obligation is going to be to not be committing fraud, which is an obligation that complies whether you're an SEC world or not. So it's just making sure that you are not misleading people and that you're giving them all the material information that they might need to make an investment decision. So what does this mean? Let's make it a little bit more concrete. And you can think of it really like a flow chart. So, okay, threshold question. Am I engaged in a public offering? If you are inviting, for example, family members, friends, people that you know, business partners you've done other deals with, those kind of folks to invest alongside you in, let's say you're setting up a BRRRR fund or you have one large asset that you're investing in, that is not going to be a public offering that the SEC is going to regulate. So when you're in that world, the other example I like to give is kind of the Shark Tank example. When you're pitching to a few investors, when you have that pre-existing relationship with people, the SEC is not worried about it. On the other side of the coin, and where you start to say, okay, I do now have to start thinking about SEC regulation, is when your offering goes beyond that group of people that you have that pre-existing relationship with. So, for example, you're going to make a website and talk about the offering that you're setting up. You are going to send an email to people that you don't know. You are going to just make it publicly known, and you're kind of reaching outside of that group of people that, under a facts and circumstances analysis, you could say, oh, I really have a actual pre-existing relationship with this people. There is no hardline test about what constitutes that relationship, but it's always going to be viewed kind of through a good faith prism, and what would the facts and circumstances really say. You can push it a little bit, but it's better to be on the safe side. So let's talk about that side of the coin, where you're actually announcing to the world that you're going to be starting a BRRRR portfolio, you're going to be starting a BRRRR fund, you found a great multifamily property that you need additional capital and investors to come into. At that point, when you're telling the world about it, you're coming into SEC world. Regardless of the size of the investors or who they are, when you start that public offering, you have to start thinking about SEC regulation. What does that mean for you? It ultimately is going to depend on two things. The kind of marketing that you're doing, what we refer to as whether you're generally soliciting investments or not, and the kind of investors that you allow into your offering. You're going to hear in this world discussion of 506B, 506C. What do those mean? Really, those are exemptions to the general rule of the SEC that if you're engaged in a public offering, you have to register the offering with the SEC and get their clearance. 506B, 506C say if you comply with either of these, then you don't have to go through that lengthy registration and review process. So let's talk about each of those one by one, since those are the most common exemptions that people in our real estate space work with. And they really differ on two fronts. The main one being the kind of investors that you can allow into your projects and the kind of marketing that you can do. 506C gives you the most freedom in terms of marketing. Under 506C, back in 2012, the SEC changed the rules so that if you're complying with 506C, you can tell the world about your offering. You can make the website, you can do your Facebook ads, you can do anything that you need to get your message out, and there's no problem. You're allowed to do what you'll hear referred to as generally solicit capital for your private offering. The contingent on that, and the thing that you have to comply with if you're going to take that broad-based marketing approach under 506C, is that the people that you sell to, those that you allow into your project, must be what's called accredited investors. The SEC has basically taken the position that if you don't make enough money or you don't have a high enough net wealth, you're not in a position to be able to bear the risk that comes with investing in oftentimes largely illiquid private investments. So for something like real estate, which doesn't necessarily have a liquid market like you would see on the New York Stock Exchange or NASDAQ, the SEC is concerned about less sophisticated people getting trapped in deals they can't get out of, and the people they're worried about are people who make less money or have less net worth than their arbitrary definitions of $200,000 a year on an individual basis and $1 million in terms of net worth along with you and your spouse. It can go to $300,000 on the income requirement if you combine your spouse's income, and now that's been expanded a little bit to include those that you share a household relationship with, so in a spousal type relationship. But the general rule is if you don't make $200,000 a year or you don't have $1 million in net wealth, you're not an accredited investor. People who are raising money under 506C are only allowed to bring accredited investors into their projects. So that requires you to look at some tax returns, do some diligence on your people. You basically have to do a reasonable investigation that the people who are telling you that they're accredited actually are. This usually includes getting some reps and warranties and those kind of things to make sure that you feel comfortable that those people actually are meeting those standards. Tax returns and those kind of things are a typical due diligence point and usually the easiest way to facilitate that. There's also some third-party verification services out there where they fill out information and you get a letter from an attorney like myself that says, okay, this person is likely to be considered accredited. So those are your limitations, but also your benefits of 506C, and I'll compare this with 506B in a second, but just to repeat, basically you can tell the world, but when you actually sell, the people have to be accredited. So you're not allowed to bring in people who make $50,000 a year or have a net worth of $100,000. It has to be $200K a year or $1 million a year in net worth. There's a list of other exemptions and ways to qualify if you're talking about LLCs, trusts, business entities, those kind of things. But for our purposes, I wanted to focus on individuals and how they can qualify as accredited investors. Let's talk about 506B. 506B basically says you can bring in non-accredited investors into your project. You're limited to 35 people. The rest of the people, if you need more, have to be accredited investors. So people say, oh, great, wow, this doesn't limit me like 506C does. I can ask people who have lower income, lower net worth for $5,000, $10,000, bring them into the project. Great. Here's the wrinkle. 506B says no general solicitation. So while the pool of investors is potentially larger that you can bring into your projects, you're substantially hampered in your marketing efforts. So under 506B, if that's the exemption that you're going to rely on to avoid the registration requirements and going through the process with the SEC, you're not going to be able to do the website. You're not going to be able to do the mass mailing campaign. You're not going to be able to publicize the offering in a way that's probably necessary to be able to get it in front of enough people to fund the project. So that's the challenge of using 506B. Comparing the two as well, if you're deciding of, okay, which one should I use? My experience has always been, it's actually a lot easier to do 506C, especially if you have a great deal, because of that ability to generally solicit, tell the world about your project. You're not as hamstrung as you are under 506B, both in terms of the number of non-accreds that you can bring into the deal and the way in which that you can tell people about it. Both 506B and 506C come with some simple filing obligations that you have to meet with the SEC, not something that should scare you away. It's something that's done online and it's not overly burdensome. This is a lot of information and people can say, oh man, is this really worth it? Why should I do this? This stage and this point of raising capital is really for somebody who is not interested in working with traditional bank loans or is unable to, doesn't want to pay the fees and expenses of private money, hard money, really looking for another way to bring other people into their offering, be actively involved in it, find another source of capital and grow that business together. People get scared away from this because they're worried about regulation and how do you comply. Last year in the US, about $1.7 trillion with a T was raised through 506B, 506C offerings. So you can get comfortable that a lot of people are going through this process. It's relatively well defined and easy to comply with if you know about this up front and you're dealing with it in a responsible way. So I hope this video helps answer the question for you of when do I have to worry about SEC regulation? Remember, your threshold question is this a public offering? If it's not, if you're talking to your parents, your friends, don't worry about anything. Just make sure you're telling them the truth and giving them all the information they need. If you're expanding your globe of potential investors, then we're in 506B, 506C land, and I explain to you kind of what the benefits, limitations, those things are. If you have questions or you want to talk about this, in the description for the video, I'm going to leave my email. I've also created a separate page on BRRRRinvest.com that is devoted exclusively to fundraising efforts. So there you're going to be able to watch all the videos that I previously mentioned about getting set up. We have some more information there about regulation and compliance. We have information there about market terms and what investors are likely to expect. We also have tons of resources available so that if you're going to go this route, you can access our template investor agreement, subscription agreement, private placement memorandum, set your LLCs up, and also get access to our BRRRR deal analysis and contracting solutions so that you can analyze all your deals and also make sure that you're hiring your contractors, property managers, leasing to your tenants on the same terms that I do. Legally strong contracts based on my own 10 years as an attorney and investor. All that's going to be there on our exclusive page related to capital raising for BRRRR investors. I'll leave the link to that in the description. Hope this video was helpful. Hope you subscribe to the channel. Don't hesitate with any questions. Let me know how I can help you. And I wish you the best in your fundraising efforts and all that you're trying to do to find your financial freedom and meet all your goals through the BRRRR strategy, real estate investing. I'm always here to help. Feel free to contact me, and I will see you in the next video. Thanks so much.